Hello, Greg.
Hey, Mike. How are you?
Good. We can't see you today.
Oh, hang on one second. Let me unplug my. Hang on.
Haha. I gotta shut my door.
Try Let me see if. Oh, my camera fell off. Hang on one second.
I can see the ceiling fan. There you are. Oh, so you have a stand-up desk?
Yeah, yeah.
Oh my gosh! The whole time I always thought you were sitting.
No, that's why my I have people that watch this and go, "You rock too much," and I'm like, "Well, I don't sit. I stand. That's why I'm constantly moving. I can't sit still. Obviously, trading markets. So, but I've had a stand-up desk now probably for a year and a half, and I love it.
Ah, good deal. It's funny. I was thinking about making the small talk at the beginning of the show, and I'm experiencing some very first world problems today.
Yeah.
Um, we have a lovely day in Chicago. In fact, I was just outside. It's like in the mid 80s, and they have the air conditioning absolutely cranked in our building, and it is so cold in here.
Are you
Um,
guys that warm?
I guess they've
That's
got the air
crazy.
conditioning cranked down. So, back a few weeks ago, we had some warm days, like, got into the 70s, and our office was hot. Now that we've gotten really warm, they've cranked down the air conditioning. So I do have my materials exchange T-shirt on underneath, but I'm too cold to take my top shirt off.
Yeah, no, I'm just happy we finally have spring here, and that it's in the 70s, and more importantly, it's not raining. My son plays high school baseball, and I think 65 to 70% of his games have been rained out this year. Like, which is just like I don't know why we try to play baseball in April in the Midwest, but it's not
Well,
like I don't think this is like a 5 day stretch where we're not supposed to have rain.
yeah, fantastic. Get all the games done. Um,
Yeah, yeah.
I mean, I haven't heard about weather impacting really any building. Have you heard anything like that?
No, not that. No, no. I think building has, in the Midwest, the Northeast, you're kind of used to dealing with elements. I haven't heard of too many disruptions down south. Maybe I guess. I know New Mexico's got forest fires, so I'm not sure if that's impacting any areas where they'll be building. But I have not heard of any weather-related type disruptions. So if anybody, yeah, no, I know, not, I've not heard of anything.
No. Well, all right. Let's kick it off. Here we are. It's Tuesday. Gosh, I have to look. May
May
10th.
10th.
May 10th. Wow. Weren't we just in February, like last week?
I'm in disbelief when I have to churn my calendar. And more importantly, we're in May, expiration later this week. So another hopefully the last expiration month before we get the new contract. So we'll see.
Yeah, and a very interesting expiration for the
Yeah, and we
market.
can,
Let's
we
kick this
can,
thing off.
yeah, let me do it this way. Okay, here we go. I'll come back to all this stuff. We'll just jump into, we'll go to basis and EFPs just to give people some perspective here, then come back to this other stuff. So as of this morning, we're at 186 EFPs. When you look at total open interest, we were 163 Mays left, down 74 yesterday. I
Can you
think,
shed some light on the EFPs? Has there been one particular item that stands out as a hot item that's been being EFP'd versus others?
as far as what I can see, it's a pretty, and again, this is just from what I see with the mills as far as what they're willing to actually EFP versus what the buy side wants. I wish I could say that it was more unusual than previous EFPs, but it's just kind of your typical bread and butter type stuff. You're always going to have certain mills willing to do certain things. Above and beyond that, again, you're going to get some 4-inch, some 6-inch. You're going to get heavier tallies where somebody wants hey, can you do this if I take this? You get the Eastern Boston stud mill that does their stuff. Outside of that, you get a little bit of MSR. You'll get some Western studs, and that's the extent. As far as
what about the Eastern studs? What kind of spread are we looking at off of futures on those?
I mean, today we're probably talking. My guess is a 1070 strike price. If you want to equate it to where May is today, based upon the adder you're going to add on what you're looking at.
So you're striking at a 1070 and without an adder, or with an adder?
With an adder, with an adder. So the one thing I want to stress to people when it comes to EFPs, the strike price, I'm not going to say it's completely irrelevant, but you're still going to traditionally negotiate the cash. This is what I want. You're going to negotiate the tally. You're going to obviously negotiate the price. You're going to negotiate your adder deductor depending on the item, where it's going. You're going to negotiate the freight, and you're going to negotiate the shipment time. The offsetting of the futures transaction, if you're going to offset futures, and there's this, idea that, we have to be at a certain strike price relative to where the board's trading at any given day. You can be well under, well over. You just need a special exemption you need the CME to approve a special exemption, the clearinghouse to approve that. And, the rationale is, hey, we're not EFPing 2x4s, we're EFPing Eastern Boston studs, or we're EFPing Western MSR. This is the relationship. This is why we're using a higher or lower number. But the important thing is you're still going to negotiate cash like you traditionally do. That strike price is just striking off the future side. The cash is going to equate to that, but built into that cash equation is going to be the normal variables that you still are, if you're going to buy a traditional cash car, you still have to negotiate all that stuff.
Is the spread, the adder subtractor, is it typically what the price reporters are saying is the spread in the market?
It can be. I mean, it can be. A lot of, does somebody want to show a loss in futures or a gain in futures with how they strike stuff off? But again, at the end of the day, it equate. You're either going to show the gain in cash, the gain in futures, the loss in cash, the loss in, the gain in cash. I mean, one side is going to equalize the other side. I mean, the big advantage of doing May here, if you're on the buy side, May last week dropped into that 980 area.
Correct.
The sawmills are all 1080 to 1100. I mean, Fraser is 1100 the week of 530 out of their southern mills. So, not that you're going to do anything with Fraser, but with some of the other mills, look, you can't buy $1,000 in the physical cash market. So that's the incentive of looking at futures here, where I can truly buy an 80 to 90 to $70 discount relative to where the mill ask price is. And I know I'm going to realistically get one of two mills in the West. And that's my negotiating power. And that, especially for somebody that typically can't buy mill direct from a Canfor, from a Tolco, they have the ability to potentially do business with these guys through futures. I mean, those are your primary participants as far as the mills are concerned.
Yeah, I mean, it makes sense. And it's quite amazing that people would actually buy from West Fraser paying $1,100 when you can go to the futures market and pay $100 $1,000 less.
Yeah, and again, at the end of the day, okay, you're either going to squeeze May up to where physical cash is, or you just have to be willing to take the wood. And that's easier said than done. It's usually the same old participants. On occasion you do get somebody new, and the hope is, as we evolve into the new contract, and it becomes truck based, you will bring in, more importantly, new buy side, but more, just as importantly, probably even more important, you'll bring in new sell side. If you're going to open this up to domestic mills, they've all quite a few domestic mills. Have expressed interest to deliver.
When it goes truckload, it opens it up to anyone who has a truckload quantity of lumber on the ground.
Yeah, and as long as it meets the contract specifications, I think the vast majority of mills will see this as an extension of order file, pure and simple. And if we can deliver into the board, absolutely, we're going to do it.
So yeah, I mean, when everything works itself out, we're going to have a massive education process here on how you can sell, how you can be a seller, and it's going to be fantastic. Anyway, that's.
But what I was going to say with May, there were 163 Mays left. I'm sorry, I'm squinting here to look at my sheet. My guess is there's another 60 to 80 EFPs that still have to be transacted. So when I look at realistically, that's going to put May, strip out those EFPs, you're somewhere in the 80 to 100 contracts left to liquidate between now and Friday. Friday is expiration, Friday the 13th. So we have Friday, for those that are superstitious, Friday the 13th, and the full moon is Monday. So,
well, my guess is that by the end of the day tomorrow, pretty much everything's going to be baked in the cake.
Yeah, absolutely. Absolutely. And then I'll jump back here, but I just want to go, here's May basis a week ago. You were at $45. As of this morning, we're up a little bit here. We're up $6 in May, but you still have a pretty significant basis relative to where print is. With the idea print's probably going to be 1090, 1100. May right now is in that 1050, 1015, 1020 area. So you still have with strip out today, you've got 3 days to expiration, and you're still carrying a pretty hefty discount in May relative to cash.
Just to point out though, I mean, there's nothing left in May. The game's been done.
Yeah.
We're just sweeping off the diamond right now. The game's pretty much over.
Yeah, and like what's going to push May up here? It's probably going to be less to do with people just magically coming in and taking the wood, because a lot of these EFPs are not speculative; they're pre-negotiated. So you're going to get short covering, and at this point, if you're short May, knowing that the mills aren't going to come off on their cash ask levels, and between now and May expiration. I'm not sure what the game is here. You're gonna that spread's traded out to 205, the May July spread. So, is there all this short covering in May? I don't know. Maybe there is, but I'm not sure the logic of being short May right now, this close to expiration, unless you're going to deliver the wood.
Correct.
And then I'm going to just jump quickly to open interest, because I think this is relevant here. So as of this morning, I'm sorry, this is last week, we were at 26.65. You can see this week
I think bump back to that. I think more importantly, 593 is the open interest in May.
Yeah, this was a week ago.
This was
on the 3rd. Yeah.
Yep.
And
so you can today.
See, we're 163 in May. And 2443. So in this process of price discovery, consolidation in the back months here, where you've had some liquidation, you're just losing May open interest right now. You're really not building. You're not seeing the spillover into the back months. So unfortunately, we've gone. We kind of had plateaued in that 2700 area with May going off here. You're back down to 2443. So hopefully we kind of level off in this 2400 area until the market decides the next bigger move.
Fantastic. Yeah, and that was a nice orderly decline of May open interest, about 100.
Yeah. No, it's been pretty, at least on my end, it's been pretty uneventful. Where I think like the shorts kind of got out of the way. Existing shorts right now will EFP. The long side has kind of had their motivation for what they're going to do. So it's been pretty orderly on both sides for me anyway. So I'm going to jump back, Mike, to the beginning, and we'll just kind of run quickly through this other stuff and then get into jump back into lumber. But like what's happened in the last week? Well, the obvious elephant in the room here is the big sell-off in equities.
Indeed.
You finally, I'm a big fan of Lowry and some of these market indicators, and you finally saw some capitulation days last week into yesterday where you finally had the margin call liquidation, down days of 90 to 95% sell pressure versus any upside, where you could say you're finally starting to see signs of capitulation in equities. And it's pretty obvious when you see, here, I'll jump forward. When you look at, these are year-to-date returns as of this morning. These are your big negative markets, and you can see, we've got the Dow, we've got the S&P, we've got NASDAQ, you've got Bitcoin. Obviously with yields going higher, inversely bond prices go down. So you've got the treasuries, and then also jump back, of interest. Look, there's also commodities here: high grade copper, silver, and our lumber. These markets are down year to date. So where, yeah, inflation's out there, but it doesn't necessarily mean all commodities have to go up with inflation. You're finally probably seeing some price demand destruction. Especially with stuff related to China and what they're doing. Their zero, COVID tolerance policy right now is having a negative effect, where crude oil was down hard yesterday, crude's down again today. And I'll jump forward here. This is pretty. This is an eye-opener stat. When you look at this year's S&P year to date, go back to 1928 through 22. We rank number 2 as far as price return, year to date here. We're down 16.3%.
I'm going to share my screen real quick, a big picture thing. Let me move this to get it to the right spot. On Bloomberg, window, where are you there? Oh, there you go. Share. Oh, is it? Oh, there we go. So this is on Bloomberg. One corner of the trucking market suggests the economy is slowing, and it's right here, flatbed trucking. They say it's often associated with housing and construction markets, and it appears it's softening. This was a big presentation at FreightWave's Future of Supply Chain conference, and what they point out here is the rejection rate. The whole way that trucks are booked is kind of messed up in my opinion, but they're basically saying that, yeah, truckers are more than willing to do loads at contract rates now, as opposed to rejecting them because they could get better prices. So
interesting. Yeah.
The tender rejection rates is what they were calling it. So yeah, flatbeds, are becoming more available. And Greg, you've been highlighting this for a while about the speed of rail cars is moving. So, if you're a bull for the commodity market, specifically lumber, and one of your rationales is that, there's transportation issues, it's starting to go away.
Yeah, no, and again, I think, I know one of the big theme for this this podcast today, Mike, do we belong at $1,000? And I think when you strip out the transportation issues, and again, that's easier said than done. There are still significant issues coming down the I-5 corridor in BC. The embargo has been partially lifted. I think there are still significant trucking issues into the west, going down to the desert, going into New Mexico, going into Colorado. But if you strip that out, and again, it's easier to say that when it's not that easy, but what's the justification for $1,000 lumber? Is it purely a logistical rail car issue? What's the justification for these numbers? Where when you start to dissect the demand components of housing, you start to look at supply issues where there doesn't seem to be supply issues down south. Do we belong here? And I think there's a hard time rationalizing these kind of numbers from an investment standpoint, with the mills at legitimately mills at 1080 to 1100, who assumes the risk? The mills, again, there's no risk for mills at selling at those numbers. It's pure profit. The risk is borne to everybody else. And look, if you have to buy that wood, you're purely a Western SPF individual going into these areas where there isn't a lot of inventory. I get it. That's your market, and there probably is value. You can't sell something that you don't have on the ground or that's not moving. But for everybody else, it's a cautionary tale of where is your risk, and that's at these kind of elevated numbers with Western SPF or just SPF in general, I think it's a legitimate concern to quantify who's assuming the risk there and act appropriately.
I just want to highlight something here just about information. This is Twitter, and this is Rick Picios Jr. He comes from John Burns Real Estate, highly respected.
Yeah.
Now, I'm not saying hang your hat on one particular person, but when you find a legitimate reporter bringing out information, you should take all this in. And Twitter is fantastic for that. Look, he's putting other stuff that he gets in from the market where, in Houston Builder reports to him many first-time buyers simply no longer qualify with the increase in interest rates as their debt-to-income ratio gets out of whack.
Yeah, and that's I'm going to skip through this. I'll skip through this. Here's your. I'm gonna jump into. I'll come back to this China stuff, but I just want to show. So, okay, here's your 10-year notes. We peaked in the 3.12 area. We're back in the 3% area, kind of vacillating, above, below 3% today. Here's your 30-year, 5.27. The obvious stuff we look at week over week. So this is not made up. This is the reality of January 6th. Interest rates are 3.22%. Your purchasing power is $807,000. Okay.
Wow. Wait, go back to that one. That's really amazing.
So look at it today at 5.11%. Your purchasing power is 643. I mean, this is in a quarter.
Wow.
So to say that this doesn't
$1,000
demand destruction, at the single family level, and we, again, we consult, we deal with home builders, single family home builders, and they are seeing signs of your entry level tranches of home builder of home single family demand keep getting ratcheted up because people keep getting priced out of this market. And so flip to the root of all this. Here's your quantitative easing. Here's the Fed pumping all the free money into the economy. So again, here's COVID. Here's the Fed balance sheet going into COVID. You get this big ramp up of all the free money flowing into the market versus, look how it correlates with the bottom in the S&P and free money pushing this market higher. So when you start to claw this money back, take the, it basically reduce your balance sheet, start to remove the quantitative easing out of the market. So house poor. Here's your, here's, we talked about, had that graph of payments starting in January versus today. Well, house poor. Here's your, again, this says it all. Here's your average mortgage payment, versus here's your start of the pandemic, pre-pandemic, you were, let's say $1,300. So you're up to $1,700 plus. So payments are significantly higher, especially for those coming into houses now. And then here's personal savings. Here's all your free money. Here's the input of Fed quantitative easing. Okay, so all this is being, you've taken away the sugar water here, and you're back down to levels now where you were at pre-pandemic. So personal savings is starting to slump. And then did I miss one here? No, I'm sorry. I thought I had one more chart, but again, how do you, again, you need the free money. The free money's gone now. So you've got to revert back to, are you seeing wage growth? Money's got to come from somewhere. So now it's more reliant on that wage growth component.
Right. And it's not just housing that costs more. Everything's costing more.
Yeah. No, we've done, and so I just want to jump back before we jump into lumber, Mike. So here's the big, this is China manufacturing, non-manufacturing. So here's their PMI numbers. So you can see this is the, non-manufacturing. Okay, everybody's staying home. So you knock out the service related industry in China. Even with the pandemic, you were still manufacturing. Look at the manufacturing number now. Because of their zero tolerance toward COVID, you're actually seeing production manufacturing get shut down now. So I'm not sure what the logic here is with the Chinese government, but you're definitely seeing signs of a significant slowdown. Again, consumption of raw materials in China. And when you slow your manufacturing, those raw inputs, commodity inputs, somebody's got to use this. And look, we know at some point they'll come out of this and it'll probably be a good push into the economy, but this just doesn't make a lot of sense. And when you look at, here's their industrial production and retail sales, again, you're just seeing a massive slowdown and trying to have this zero tolerance with COVID, where it's almost the cut the nose off despite the face mentality with what they're doing right now. It just doesn't make a lot of sense.
There's going to be a ripple effect of this for sure down the supply chain.
Yeah, so I'll get off my soapbox here and we'll jump into lumber. So seasonality, red line is last year. Green line is obviously this year. So, we're at that point now where we topped out last year. We kind of have a tendency to drift lower into Memorial Day weekend into the third week of June. So seasonality says we should see lower lows, lower highs in cash and futures going into the end of this month, into the third week of June. Here's a weekly continuation chart. So, we're kind of in between January, March, November, September. I guess somewhere in between lies the truth. And May is kind of almost smack dab in the middle. You almost have your, this is your 50% retracement. So you're kind of stuck. I want to say kind of in no man's land, where does this thing want to go to next? And I guess that becomes a function. Are you a bull or a bear, or what do you see? We're just in consolidation mode. And so then you jump into the May daily. We're kind of more or less just trading sideways here.
But May's pegged to cash right now.
Yeah,
and
exactly.
I think when we started advertising the show, we were talking, what's this chart going to look like next week? All of a sudden, there's a $200 gap in the chart, the continuation chart starting.
Yeah, no, and I think that's, the expectation is, let's say May goes off at 1020, or whatever in this $1,000 area. July is $810, so the expectation will go to July. So May's gone sideways. July's kind of taking it on the chin here. Probably more correlated with the action in equities, the sell-off in equities, than anything else. Sorry.
I think right now, I think July is just being held up by May. Like, July looks like it wants to take out these lows.
The devil's advocate will say that this is the cheapest wood out here, and you buy that in. We'll go back to the inverted futures curve here in a second, but okay, you're into the Bollinger Band low. And I know you mentioned this, Mike. I figure next week I'll do a little bit more preparation and we'll get into some technical indicators, because I know that would be good to talk about some of these indicators.
Speaking of that, if you want to talk a technical indicator, if you jump back to the chart previous to this, nope, the continuation chart. There we go. So the first thing I see here is a classic head and shoulders pattern, which we can kind of talk about. A head and shoulders is a signal of a big reversal of the trend. And when I look at this, the way you're supposed to measure it is you draw a trend line from the lows of July. I'm sorry, the beginning of this year and back in March, measure the distance between that line and the peak, which is, we'll call that about $500. And you measure that from the break.
Mm-hmm.
When it breaks through, that projects down to like $300, $1,000.
Right.
Which people say is unheard of, but was it? Not that long ago, it was, a possibility. But we'll take a look at those technical analysis next week.
Yeah, no, I think next week I'll make note. We'll go over a head and shoulder pattern. We'll explain that, and then we'll explain. I think moving averages would also be good to start with.
Yeah, moving averages are fantastic. I love it. Okay, moving on.
Back to July. You've had the sell-off. Are you going to double bottom? Yesterday's low was 780. This double bottom would be in a 758 area. And the whole point here, let me find my inverted curve. Here's your May, here's July, here's everything else. You want to own the cheapest wood out there. So you want to own this curve. Again, the expectation, does this mean that there's value here? Well, that's to be determined. But what we do know that I'd rather own $810 or $750 than own $1,000 or $1,100 wood. Because if this truly is right and we're at $1,000 and we're just going to trade sideways, then you will get price appreciation in these back months and they will move up into where May or physical cash is. But if these numbers are more of a telltale sign, then look, that doesn't mean July can't go lower. July could go to 750, July can go to 700, but your risk of ownership is a lot less down here than it is up here. There's a lot more risk up here than owning the price curve, where if this is wrong, this is going to be less wrong than owning cash at these levels, at today's levels.
There's another thing inside the back months when you look at, I love this chart, by the way, but when you look at a chart like this, one of the factors that you can't discount, like it's a real deal, is the cost of carry. Cost of carry simply means if I buy wood in July, what is my cost on actually just holding that wood? And there's two costs, three, but two real costs, meaning the storage and the cost of money. Now, up until about 2 months ago, cost of money was negligible. But right now, you're looking at 5% to carry that at a minimum. So from July of 22 to May of 23, you're talking about a year of interest at 5%. That's significant. So theoretically, July should be, or the May of 23 contract should be 5% higher, just because the cost of money.
And that's your traditional, like, normalized lumber structure is more of a carry market, where as you go further out, you do have that cost to carry. In an inverted structure, obviously there's more need for prompt wood, less need the further out you go. So, that's kind of why you have this inverted structure. It's funny, Mike, we have a customer that was complaining, he basically goes to a jobber and they sell him the wood. And then as his needs come due, they deliver the wood. Well, they were charging him a cost of carry. And he's got about 30 outstanding cash cars, and he's looking at this structure and he's like, well, wait a second, how are you charging me a cost of carry? So he called them on it and said, all right, I've got 30 cars, deliver them right now. And they're like, well, what do you mean? We don't have the wood to deliver. Why would you want 30 cars right now?
I'll internalize that cost, right?
Yeah. And he's like, well, you're charging me a cost of carry. So how could you charge me a cost to physically carry wood that you don't own for me? So I think that's the whole thing. The beauty of what you guys do is, we're here to call the fluff out and help the industry truly achieve price discovery and all facets of the industry. That's something I immediately thought of you guys as far as the whole idea of price discovery, where you're paying a cost of carry on something that the other side doesn't own yet.
The power of information and education, just understanding what the cost of carry is and understanding what it is in actuality today, allowed this customer of yours probably to save, on 30 cars, 5%.
Oh yeah, yeah.
Over,
No, it's just insane
we
that
probably saved $50,000 maybe.
yeah, oh, easily. Yeah, yeah. No, so that's I love stuff like that. And so going back to the idea,
By the way,
going
you
back.
know what your suppliers don't want you to know? Information and education. Just leave it up to them. They'll take care of you. So being an educated buyer is nothing but good for you.
Yeah, and I'm looking at there's a question from Brad Kittle. Our brokers. That's a great question. I don't have a good answer, Brad.
You know
You
what
see
I
that,
can
Mike?
tell you though, Brad, is the increase in prices have opened people's minds to alternative species and alternative products.
Yeah.
We last week sold a truck of 2x4 10-foot southern yellow pine in Wisconsin to a framer. And you know, traditionally Wisconsin is a Western species or Canadian species market. And we said, well, you know what? Why are you buying this? The guy's like, I don't care what it is. It's 2 inches by 4 inches by 10 feet long. One might be a little heavier. He goes, I have nail guns. I don't hammer it through by hand. If I have to turn the power up on the nail gun a little bit, so be it. Big deal. Let's move on. I'm buying it cheaper.
Yeah. Yeah.
And we sold last week Brazilian pine plywood. Guess what? It works just the same as the traditional North American plywood. So I think the specialty woods or different species, if you can open your mind up to a way to use them and the application and use of it is the same, why not save some money doing that?
Yeah, absolutely, absolutely. And I think that's the nature of the beast moving forward is that there's less loyalty to a species or a supplier as much as I want, the immediacy of the best price. And you're more than willing to look at different items, different species, different vendors now. And again, that goes back to the question: do we belong at $1,000? And if you just say over the last 2 years, yeah, we belong at $1,000. Well, 16% of the time we're at $1,000 to $1,500. So this is over the last 2 years. 20% of the time you're at 750 to 1,000.
So really, under 750 happens the majority of, what is that, 37% of the time over 750. So 63% of the time you're under $750 per thousand in the last 2 years.
Yeah, and again, we know that there's some kind of paradigm shift with lumber, and that there's a higher cost of production. Do you belong at $350 to $450? Well, if you're going to do it based upon a cost of production standpoint, you could make the case that southern yellow pine would be the species that could touch those numbers. When you get into fir, you get into spruce, you're probably talking somewhere in the 650 type area as far as your cost of production. So again, you look at a 10-year, okay, you're at $1,000, you're there 2% of the time. You're at 750 or greater, you're there 4% of the time. So what's the new normal here?
Well, I want to talk about that kind of cost of production thing in a different light. I'm going to share my screen one more time. Let me turn this guy on. I just saw this information. Oops, got to get you out of the way. Here we go. This is softwood lumber imports into the United States from January through March of 2022. And it's the change in percentage over the previous, over 2021. And absolutely true to form, the amount of fiber wood we're getting from Canada has dropped in the last year, almost 10%. You can't argue that. And, the Canadians have been beating the tom-tom, and they are correct. They have less fiber to ship in. But at elevated price levels and elevated, dollar count, as the dollar is stronger, it has been absorbed by other countries coming in. If you take a look at Germany and Sweden, they've increased their production coming to the United States. Overall, only 5% less wood was imported into the United States. So what is that? That's 3.3% of the drop in Canada was filled in from these other countries. So I think the lumber market is a big system, and the system will take care of itself over time. By when you have high prices, more wood will show up from other places.
Yeah, and again, dovetails into one of the charts I had, Mike. Here's Alex at Stone put this out this morning. Here's European imports, and you can see the green line is 2022 versus since 2015, and we're right on target, to exceed last year's, you know, basically last year's levels. We're still seeing this increase, and again, there's speculation that there's going to be less wood coming out of Europe because of what's going on in the Ukraine with Russia. We'll see. I mean, again, I think as long as the returns justify it, you're going to go to your highest returning markets. And right now, so far, I think Europe is getting extremely high returns into North America, into the U.S. relative to keeping it in Europe.
Shameless plug for Ashley's show tomorrow. Russ Taylor is going to be on, and he has recently
made a trip. Okay.
He's going to be recently made a trip to Europe, and he's going to shed some light on is Europe losing fiber or not from the Soviet area. Somewhat spoiler alert, it doesn't appear so, but you should listen to that show tomorrow. All right, moving on.
Let me take a look here. Where we were at, we'll go into, I think we were in basis. We talked about the histogram stuff. So, it just, again, evolving, trying to figure out what new normal is. So we talked about May basis. Here's July basis. A week ago, July was $160 under physical cash. Today, July's $282. So we've had a bigger sell-off in July relative to May. That May-July spread has widened back out. It's 205 up 370 today. So again, you've had the detachment of July Sep Nov, probably more reactionary to the sell-off in equities, and May more a function of that convergence with physical cash being your prompt market and the divergence between the two. So again, is July a sell? Historically, the answer is probably yeah, but you can obviously make the case if you're a forward type buyer that I'd rather own July at $282 under where the mills are and take my chances on this versus buying cash.
Absolutely.
September,
I think
225 and then 305 today. Go ahead. I'm sorry.
But what you can think about is, given the economic conditions of today, am I planning to do this massive project from scratch based off of July's numbers? Yeah, maybe not. But it's probably more looking at like the September and the November contracts from a pure planning standpoint of a new project coming on. I think that the construction that we will experience between now and August 1st is baked in the cake, already planned. Wood's probably, a lot of it has been procured or in the process of being procured for that time frame. So I think July is going to be pegged pretty close to where it's at, maybe a little lower from now. But the back months, we could see some buoyancy in those back months.
Yeah,
I think
absolutely.
we can get to that carry.
Yeah, no, and I think the one thing I'm seeing, especially in July, but Sep, Nov, Jan, there's definitely interest for guys that have cash shorts or have shorted jobs to go in and cover at these discounted levels to cash, where they'll take their chances. Again, you're going to own the cheapest wood out there if you can lock in these kind of returns, especially in the back months. At a $300 discount to where print is, you might as well do that. And then here's November. I didn't update the November, so I'm going to skip that. So spread-wise, a week ago, that spread was in the $17 to $120 area. This is May, July. Today, we're out at $200. So again, May's held in there. July's the one that sold off to widen the spread. Um, you had this spread top out at about $175. It came into the, let's call it 35 area, went back out to 200. So it's similar from a pattern standpoint to what it did last year, where you topped out at $175. You actually came into about 50 under, and then went back out to 175 over. So from a pattern standpoint, this year is pretty similar to what we did last year. Is this indicative of, are we still in a bull market structure? Well, if you look at May, July, and you're a believer in this, then yeah. When you look at July SEP, you look at SEP NOV, this spread has narrowed into $16 as of yesterday. July SEP NOV narrowed into 1760. So if you're a believer that May, July at $150, $170 over is indicative of what's to come, then these are really good buy opportunities in July SEP NOV. Personally, I don't know what to think. I don't know what kind of upside potential is, where realistically this spread could go back to the 45 to 50 over area, and you're probably more likely to be range bound than anything else. It doesn't necessarily have to collapse to historical type averages where you would be at even money to 20 under. But the idea of this going back out to 100, I'd want to see some pretty significant continuation of supply disruptions to justify that, or some kind of
Well, I mean,
surprise in demand.
I'm looking at the July SEP and I'm saying, wow, we're getting some normalization, and going back to the cost of carry idea, the spreads generally should be a negative number, like all things equal, they should be a negative number. So I look at this chart and boy, I tell you what, if it can't hold those lows, then I think we look at July being a discount to SEP.
Well, and again, if you're going to go back to that carry structure, if you're going to go from the inverted structure back to a carry structure, then you'll see it in the spreads first, where all these spreads will revert back to even money, to trading front month trading at the discount to the next month out, and so on and so forth. So you'll see July SEP fail here. You'll go back to even money to 10 to 15 under. You'll see that SEP fail here and go back to 15 to 20, 25 under. And that'll be the sign that you're reverting back to that carry type market. You'll see it in the future spread structure first, where you'll see that carry structure develop first there.
There's a lot of really good foreshadowing, good information in watching spreads.
Yeah, other than I know we covered, we'll do CFTC numbers.
Nothing significant there.
No, I mean, this is last week. This is this week. There was a build in managed money longs, which was encouraging off the lows here. Other than that, you're just getting liquidation. I know we talked about this, you were a heavier concentration of non-reportable longs to short. So you finally saw the corrective move here, where you probably washed out either May and or July longs here on this flush lower, especially in July. July selling off from, and at one point July was 900. I think last Thursday July was it got up into the 908 area, or actually last Friday it got up to 908, and then we sold off to 780. So that probably well, again, this is as of the 3rd, so that wouldn't reflect that. But just this liquidation in July, you wash out the week-ended longs. But no, there's nothing obvious as far as CFTC numbers that jumps out here.
No.
We went over that. So rail car velocity. I wish I had the Canadian and U.S. Updated charts, but for whatever reason, they're not updating them on their website. So as soon as we do that, we'll send those out. And other than that, I think that's everything I had, Mike.
Yeah, I think, there's kind of an overall theme, which is we're moving back to a little bit more normal market structure. It's not all a one way. It's not a market of, I can't get my hands on it. It's like there's availability of product. I think these projects are getting finished up. Going into the summer months, it'll be really interesting to see how the home sales go. I think that's going to be one of the big drivers. And keep an eye out for Home Depot and Lowe's earnings.
Yeah.
Where we can take a look and see what's going on in the DIY sector.
Yeah, and on a short-term basis, we have the inflation reports this week, CPI, PPI. So everybody will be fixated on that tomorrow and Thursday. As far as are we, officially, if the inflation numbers come in lower than expected, then I think could be a catalyst for more of a short-term bottom in equities. If they're bigger than forecast, then look out below, and that you can continue to wash out longs here in equity. So those are the big numbers. And then housing starts next week, where I think, let me see, are they Wednesday or Thursday?
Yeah, overall, it's a challenging market. It's fun when you can basis trade, right? You can just buy wood and sell the board. This is that market where you have to be very strategic with the selling side, because if you're selling for July right now, your big competition is the futures market.
Yeah. Yep.
And how are you using it, or how is your competition using it?
Yeah, any questions, by all means, please ask us. If anybody would like a copy of this, just let us know. And I'm looking at Brad's, I know Brad, I don't have any, I wish I knew more about this, but I don't. I think he brings up some valid points, but I don't have, that's kind of outside my wheelhouse.
Yeah, exactly. I don't think it's a big enough sector of the business the salvaging wood is a big enough sector of the wood to move the needle. So, all right, everyone, thanks. We'll see you next week. Greg, appreciate all of the good information as always. And what a different world we're going to be looking at next week. May's gone. So it's going to be all these massive basis opportunities to forward price.
Yeah, no, and I think, Mike, we'll definitely pick up the technical indicators next week with head and shoulder patterns and moving averages as well. I appreciate
And if
it.
anyone has any particular, moving average or whatever you want to us to go over, any technical analysis or technical indicators, let us know. We'll dive into them.
Yeah, sounds good. Thanks a lot.
All right. Take care, everyone.